Hello, hello, hello. Let's get into one of the hardest parts of GCSE Economics, exchange rates. Let's go. So we've got to cover a lot of things today. The difference between floating and fixed, how exchange rates are determined in the market, the causes of fluctuations, and we've got a few graphs to look at with that as well. So how do we define an exchange rate? Make sure you jot this down. It's the value of one currency expressed in terms of another currency. So basically, how much of the other currency can your currency buy? Have a look at this graph here. This is the cost of the Great British Pound in terms of US dollars over 5 years. So, and even this kind of concept confuses a lot of people. Just the idea though, that I have dollars, how much is a British pound costing me? We can see that in the early stages, it became cheaper to buy British pounds. Later on, it started to cost Americans more. Then in 2020, during COVID, it cost Americans a lot less to buy a British pound. However, over time, the pound rose against the dollar, it became more expensive, and then dropped significantly again 2022 to 2023. So exchange rates keep fluctuating all the time for a multitude of currencies over many different countries. It's a very complex arrangement. And there are three important types of exchange rates. Firstly, we've got a floating exchange rate, which is where the government enacts no control at all. They just let the exchange rate freely flow as it should under the rules of demand and supply. By that I mean, if people buy more of your currency because you've got things that they want, the value of your currency goes up. If people buy less of it because you no longer have things they desire, the value of your currency goes down. But a lot of governments like to enact a little bit of control, and they do this with a managed float. So basically, it is a free market, but the government will step in now and again to adjust the exchange rates. And then we have a fixed price. Fixed price controls are permanent. It doesn't change at all. However, on the black market, you might be able to get away with getting exchange rates at different prices. So let's start with a floating exchange rate. Look at that gorgeous picture. This is where a country's currency is determined by the foreign exchange market. As I said, demand and supply. Are people buying more of your currency or less of your currency? So here is a rough example of a graph. Maybe I've introduced this graph a little bit too early. However, you can treat it a bit like supply and demand. So the only confusing thing is making sure you label the graph correctly. Okay, so this is a US person, okay, looking to buy British pounds, all right? So we're inside the USA, all right, to make it easier. You can see here it says quantity of pounds, and here we have pound to US. So everything is related to demand and supply. This is going to be demand of British pounds from the Americans, and this is going to be supply of British pounds by everybody. It could be Americans supplying it, it could be Chinese supplying it, anywhere that's supplying it online, because Americans are going to be buying it online, right? What we can see in this case is, in America, they thought, you know what, more people want to travel to England. England is selling decent products, wind farms or whatever. America is going to increase their demand for pounds because they want to buy things in England. If that happens, just like demand and supply graph, we can see that the price of the pound has gone up because now we've got sellers that know it's popular and they're going to adjust their prices accordingly. And then we've got a larger quantity of pounds in circulation in America. I hope that makes sense to you. So like I said, there's minimal government intervention, and we can see this process has increased the price of pounds from 150 to 170. So the pound has appreciated against the dollar. Now, have a quick look at this graph. What's going on here in this floating market? So the cost of the pound has gone down, meaning the pound has dropped. Therefore, the dollar has appreciated against the pound. The pound has depreciated against the dollar, because now you can buy more pounds for the dollars that you're using. I hope that makes sense. My question to you is, if you want to pause the video, what are some advantages of this kind of hands-off system where the exchange rate freely floats? So the first one, reduced need for currency reserves. A government would normally hold currency reserves in order to manipulate the market later by buying and selling currencies to adjust the value. Don't need to do that anymore. It might boost exports. If the value of your currency goes down significantly, people might buy more from your country. It might be cheaper to buy wood or coal or whatever it is your country sells. What are some disadvantages of a floating exchange rate? Incredibly volatile. It goes up and down, and you have little control over it. It could cause massive inflation if all of a sudden large companies want to buy the products you have and they buy lots of your currency all at once and therefore lots of goods in your country. If your supply cannot keep up with the demand, bang, inflation occurs. And it can lead to instability. If overnight the cost of your currency becomes so high, it might lead to other businesses not investing in your country and stuff like that. All right, let's move on to a managed float. So a managed float actually is done by loads of these countries that we see on the right. According to the IMF, it's 43% of all countries. It's not a small amount. So how does it work? As we saw about the previous one, that was a free floating currency governed by the laws of demand and supply. However, in this case, authorities like the government might intervene if the currency goes extreme either way, either depreciates too much or appreciates too much. They want to keep it balanced and stable so that other people will be willing to invest. How do they do that? Well, to be honest, you don't need to know exactly how they do that at the moment. The level of complexity is beyond GCSE. However, I will say that basically the government hold reserves of other currencies. So Americans might hold millions and millions of British pounds, okay? And if they want to push up the value of American dollars, they can use those British pounds to buy American dollars. And they can do the opposite if they want to lower the value. So that's all they do. They just use other currencies to push up or take down the value of their own currency when necessary. But for this level, you don't need to know all of that. Fixed price exchange rate. Now, this is a peg system and it happened in Thailand during COVID. Very, very interesting. The value of one currency is tied to another exactly. And most of the countries that do this connect to the USD because the USD is seen as the most stable currency out there. A really good example is the Hong Kong dollar. It's been pegged to the US dollar since 1983. So they try to keep this exchange rate 7.8 exact. And they do this by holding, like I just said, lots of reserves, and they will buy and sell Hong Kong dollars, and they will buy and sell the reserves of other currencies in order to maintain this 7.8 ratio, just to make business completely stable when you're investing in Hong Kong. And that's why they've arguably done so well. People love stability. And the Danish krone is pegged to the euro. Why might countries wish to peg their currency to another? Can you think of some reasons why? They want stability, like I said before. Stability is key. All these points basically relate to stability, okay? And it simplifies trade and finance for large organizations. It's just about attracting investment, really. So let's have a look at the graphs. This is the hard part of exchange rates, which a lot of students struggle with. So we'll go into a bit more detail in it. Okay, so this is Americans buying the British pound, okay? So all this is supply of British pound, demand of British pound, quantity of British pound, and USD to British pound. Okay, so let's keep that all legit. Now, so let's have a look at the increase in demand from America using our rules of demand and supply. So if we just quickly look at the lines, demand of British pounds from Americans would increase as the price went down. This is because they become comparatively richer and can afford more. Supply of British pounds would increase because people that hold on to those British pounds will be willing to sell them as the price goes up. And then we have our equilibrium here where we meet in the middle. And now all we're doing is just saying Americans have decided they want things from the UK. So bang, they're going to buy a lot of things. This is what happens. Demand for the British pound increases. So the curve shifts to the right. The original price of a pound was 1.1. Now Americans need to pay 1.2 to buy a British pound. If you think about it like any other product, think about it like a bag of potatoes, or think about it like a mobile phone. Think about it as an object, and that makes it easier to understand. In this case, we can see the dollar depreciated against the pound because it cost you more dollars to buy it. But now what we need to do is show the other side of the graph where the supply of pounds has increased, okay? Using the same graph, we've got a different scenario. Let's say the British will supply more pounds in the market. They've had quantitative easing, or there's more people willing to sell pounds. So what happens in the American market then is the supply shifts forward. Now, the Americans, it's going to cost them less to buy a pound now. So the USD is going to appreciate against the pound. I hope that makes sense on this graph. Okay, moving forward. The Japanese yen has depreciated significantly. Let's have a look at this video and identify positives and negatives of a depreciation in currency, okay?
If we look at the Japanese yen right now, they're under tremendous downward pressure. For one thing, we have the Federal Reserve gradually going back to its hawkish tone. That's not helpful in terms of the yen strengthness. In the same time, we also have the U.S. rising treasury yields, and the interest rate differential between the U.S. and Japanese currency and Japanese economy is certainly not helping the Japanese yen. That's why we are having BOJ governor this morning warning that the weak yen could cause rising risks in the country, especially overshooting prices as a whole. And in the meantime, these factors could actually put Japanese authorities in terms of BOJ and also Ministry of Finance into a dilemma between supporting Japanese growth as well as stabilizing the yen. And don't forget that we weaker Japanese yen is also hurting Japanese companies as well. Of course, we've heard the CEOs of Japan Airlines and ANA warning that a weaker yen could hurt their profit margin. In the same time, don't forget, Japan also imports most of its energy products from overseas. So a weaker yen means shrinking profit margin for those companies.
Thanks very much, Henry, for that update. And speaking of the weak yen, monthly visitors to Japan hit a record high in March as the yen tumbles, as we've mentioned. Official data shows March visitor numbers crossed the 3 million mark for the first time ever as tourists flocked to Japan to see its famous cherry blossoms. The Japanese yen has fallen sharply to a 34-year low against the US dollar.
Okay, so quite an interesting video. Did you get all the details about what's going on? It's at a 34-year low. Pretty crazy, right?
For visitors, but Japanese consumers are feeling the pinch.
Have a look at the bottom line here. I think hotels, transportation costs and restaurants are more expensive. Think about all the foreign tourists coming in, buying these foods and pushing up the prices. What is another word for that? Inflation. Have a look at this situation. This person can no longer travel abroad because the yen has dropped so significantly that traveling abroad costs more yen. It's therefore more expensive for Japanese residents to ever leave the country. Okay, so to go over what we saw in the video, it's going to help exports in Japan, right? Because now Japanese goods are really cheap. People from abroad are more willing to buy whatever Japanese companies produce, from cars to electronics. I know when I was there, I got some wonderful Nike trainers. Absolutely delightful to benefit from that exchange rate gap. Economic growth. So people buying from abroad might actually boost the economy, you know? Businesses are going to have more transactions to process and be able to sell more. Inflation can be a problem. If their economy faces deflation, then a little bit of increase in inflation might be a okay thing. It depends to the extent of which things in Japan inflate in terms of prices. And of course, tourism boosts, which obviously are going to make Japan a lot of money. Now, there are some negatives. If you are a company that buys products from abroad, it's going to cost you so much more for your company to operate. Another word for this is inflation, but inflation from abroad, import inflation. Domestic consumers also buying from abroad are going to face massive price hikes. And foreign debt will increase if our Japanese people owe money to other countries. They have to exchange their yen for that money before they pay the debt every year. So that increase in foreign burden of debt can be a real problem. Okay, let's have a look at the other side. The Mexican peso has appreciated significantly, okay? Let's have a look at what's going on with them. Think of the positives and negatives.
U.S. manufacturing activity weakened for the longest stretch since 2002 last year, and Chinese activity contracted in 10 of the past 12 months. But there has been one big winner: Mexico. I'm going to explain the big wins we've seen from Mexico. Its currency is the strongest it has been in almost a decade. A flood of foreign money is coming into the country, and a wave of big-name multinational companies are moving in. And I'm going to explain how this all ties back to the trade war. Let's get into it. Mexico's currency has been unusually strong recently. The Mexican peso has risen by nearly 10% against the dollar over the past year, and in March, reached its strongest level against the greenback since 2015. Since early 2023, most other currencies have weakened or lost value when compared to the dollar. Even more impressive, the peso has bounced back from the record low levels it hit following the election of Donald Trump as US president and the COVID-19 pandemic in 2020.
So looking at this, when Donald Trump got into power, the investment in Mexico significantly suffered, and that's why the cost of Mexican pesos significantly dropped. However, it seems that this has been on the rebound, and now Americans are investing more of their money in Mexico.
I talked to Juan Pablo Carriedo, CEO of currency exchange firm Monex USA. He told me that the interest from US companies in the Mexican peso is unlike anything he's ever seen. And the share of Monex's revenue that comes from Mexican peso transactions has more than doubled since 2016. Overall, foreign direct investment in Mexico from outside countries in the first half of 2023 jumped 41%.
So, interestingly, even though the cost of the Mexican peso in relation to the American dollar is higher, Americans are still investing in Mexico even at these more expensive rates. It shows that there must be some really good things going on over there that's stimulating this positivity.
And the country's economy grew by more than 3% last year, even with some of the highest interest rates in the world. Morgan Stanley estimates that other countries will buy up $609 billion worth of Mexico's manufacturing exports over the next 5 years, an increase of 34% from last year. JP Morgan Asset Management's Gabriela Santos told me recently that the strength of the peso, combined with Mexico's high interest rates, have made the country a very attractive destination for foreign investors. And she says the trade.
Why would high interest rates make a place attractive for investment? It's because businesses and banks can be honestly really simple, way more simple than you think. They just look around the countries and they say, which country, when I put my money in their bank, will give me the highest interest rate? And then they go, okay, I'll do that. And they do. And so if Mexico's offering a high interest rate and you don't do anything and you're getting 6% return on your investment, then you might as well put your money in there and leave it, especially if you believe the economy is going to do well.
War driving companies to invest there is a huge part of the story. Companies like Tesla and Chinese electric vehicle maker BYD are expected to set up major production plants in Mexico this year. And companies like Unilever and Foxconn have already made big investments in plants and production. The US and China have been engaged in a trade war since 2018, with the US putting a 25% tariff onto certain goods imported from China. The goal of tariffs is to reduce the amount of imports that a country buys, in this case specifically from China. And that's happened. In 2023, the US trade deficit with China shrank to the smallest it's been since 2010. It marked the first time in 20 years that Mexico's exports to the US surpassed China's. But that's not because Americans have stopped buying goods made by Chinese companies. It's because many Chinese companies and US firms that do a lot of business with China have moved their operations to Mexico. And they are shipping products to the US from there using the US-Mexico-Canada Free Trade Agreement to avoid the tariffs. Most goods the US imports from Mexico don't carry a tariff. And American trade law applies only a 2.5% tariff to.
Interesting. So if you set up your business in Mexico to produce cars, you are paying lower wages because the average wage is lower over there. You're paying lower construction costs, and then you can just ship the cars across the border for no tax. So why not do that where you can save a lot of money? As you can imagine, this results in a greater purchase of Mexican pesos, which pushes up the exchange rate. And Mexico seems to be thriving. Jobs are being created, products are being made, and these products are definitely being sold. The quality of life for so many Mexicans is increasing because of this. So let's have a look at the positives of this appreciation then. Reduced import costs because the value of their currency has gone up so much they can buy things from other countries for a cheaper price. Investor confidence, like investors investing over there, even if it boosts their currency and becomes more expensive, they still want to invest. So it seems like a massive amount of investor confidence is going into Mexico. And economic stability. If it's believed loads of companies are investing there and it's boosting the economy, it's great overall. It's going to influence more people to invest over there and make people have a sense of confidence for the future, not worrying about losing their jobs. But on the negative side, if we push up these the value of the peso too much, people from abroad might be less willing to buy these Mexican goods because the prices have gone up significantly. They might find them cheaper from another country. Also, domestically, if prices are increasing significantly, consumers may not be willing to buy these products from within their own country, and they might prefer to buy these products from outside as their currency appreciates. Okay, next question. What are some of the biggest changes in exchange rates that we can see? What causes them? I have 10 different points. I want you to just pause the video, have a look at each one, and see if you can briefly explain each of them. I'm not looking for a massive amount of detail, but a rich understanding would really help you in this subject. So, relative inflation rates. If inflation is higher in your country than in another country, that means the cost of your goods are going up faster, and therefore people are less willing to buy from your country. That's it. That's all it is. Next, relative interest rates. If your country offers a higher percentage interest in your banks for savers, more people are going to send money to your country in order to make money back. That's it. That's called hot money. Next, speculation. Gambling. Oh, I think this country is going to do well. Let me buy their currency now. Next, change in competitiveness. So if the UK become more successful or better at producing certain things, more people are going to want to buy from them. It really is that simple. Next, relative strength of the currencies. So when large organizations have money and they fear instability in certain countries, they might just randomly invest into yours where they feel like it's safe. And that's why Japan had its yen appreciate when it was felt the US and the EU were unstable. So in this case, strength means support or worry about lack of stability. Balance of payments. That's actually the next topic in this, and it's one of the hard topics. Basically, it just means if the residents of your country are spending too much abroad, money is leaving your country, increasing the supply of your currency in other countries, and then the value of your own currency is going to drop, which might not be very good for your exchange rate. Next is government debt. Do governments have to pay debt from abroad? If so, this is going to lower your exchange rate because you're sending money out. 8, government intervention. Are your government holding reserves and then using these reserves to buy back your own currency to make it look stronger? Maybe they are. It depends on the degree of government intervention that will determine how exchange rates change. Let's just quickly do a real life example of this because it is a bit complicated. We can see here that, so we're inside the UK here, okay, and the UK wants to buy more American dollars. So what we're going to show is the demand of USD increasing inside the UK, all right? So that's what's happened here on this graph. Now we know the cost of dollars has gone up in the UK, meaning that the pound has depreciated against the dollar because the dollar is more expensive. But what happens in the American market? The American market, inside America, we have to flip this concept on the graph. So this was demand of dollars, but this is demand of pounds, right? So if we flip these concepts inside the USA now, because the British people have bought more dollars, that means they're technically supplying more of their pounds, aren't they, to the USA? So inside the USA, where it's flipped, where we're looking at US people buying pounds, the supply of pounds in the US is now much higher because we've sold basically our pounds to buy dollars. Now, so in the US, it looks like, wow, we can see that the cost of pounds to a American person has got lower. So both these graphs represent the same thing, where the dollar has appreciated against the pound because it's cheaper for Americans to buy the pound and it's more expensive for British people to buy the American dollar. I hope that makes sense. Next, economic growth or recession. A recession might cause a depreciation because hot money flows out. But there's loads of factors. What if all countries are having a recession at the same time? It might even remain unchanged. And finally, the rate of growth. If your country is growing quickly, you might be buying a lot of things from abroad to supplement your fast growth and implement things for new businesses. Yeah, and that might lead to your currency depreciating as you're buying more from abroad. Or it might mean that you're attracting more investment from abroad, which leads to an appreciation of your currency. So let's do a quick end game recap then. What are the consequences of an appreciating currency? Cheaper imports, more expensive exports, potentially reduced inflation, worsening trade balance as your domestic residents keep buying more from abroad, lower earnings for exporters as less people are buying from you, but your domestic residents will be traveling to abroad and enjoying their lives a bit more. And the opposite for depreciating currency, we've got more expensive imports. It costs your domestic residents more to buy from abroad. On the other side, you've got people willing to buy more from you because your currency is cheaper. You might have more inflation or import inflation, as they say, as people buy more from you from other countries. You might have an improved trade balance because people are buying more from you than you are from them. If you export your goods, you might get higher earnings because, as I said, your currency is now cheaper. You're going to have more customers, depending on elasticity. Your residents won't be able to travel abroad like we saw in the Japan video, and you have a large boost for domestic industries that are pumping out goods and services and selling them abroad. Okay, 2 quick real exam questions. Let's go. What is the meaning of a depreciating currency? Pause it, write it down. Okay, the fall in the value of a fixed exchange rate, or the fall in the value of your domestic currency in relation to other currencies. That's how I would write it. Yeah. The second part makes more sense to me. A fall in the value of a currency relative to another. And look at that, fall, decrease in exchange rate. But if you wrote fall, decrease in currency, you get 0 marks. So be ready for that. Let's try again. Next, explain 2 advantages of a floating exchange rate. This is a real past exam paper question. We're going to look at the current account next week, but the idea that if you've been spending too much abroad and the supply of your money is in another country, that means it's cheaper for people to buy from your country, so the money would flow back in. If your currency is too expensive, people don't buy from you. If your currency is really cheap, people buy more from you. So there's an argument that the current account automatically stabilizes. We'll look at that a little bit more later. Another thing we looked at earlier was no currency reserves are needed. A government isn't manipulating the exchange rate, so they don't need these reserves. And this backs up the same point. Yeah, so basically it's just the idea that there's a lack of government involvement. The government don't need to get involved. They can let the beautiful supply and demand nature take effect. And that should lead to good market outcomes depending on how stable your country is generally and how large your country is. All right, that was a tough one today. That's it from me. Have a great day and I'll see you all again.